We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here or put it in there. Should I buy this real estate?
Like, I don't know what to do with this money, and I don't want to just blow it and spend it.
We were concerned about our financial health and just wanted a better financial picture.
And so when Earned came onto our radar and we sat down with our financial advisor, it just felt different.
I think a physician specifically should look at Earned because the focus is on our field. They know what a physician goes through at different phases of our career. To have that knowledge in order to guide us, I think is just such an advantage.
Earned isn't just about giving us financial advice. They're about doing the things that are needed to be done in order for you to fulfill your financial plan that they have created with you. And that really was very meaningful to me.
Earned is kind of like the conductor of an orchestra. You know, you pull in the trombones, you pull in the trumpets, you pull in the percussion. But Earned is the one that's holding the baton. I feel trust that they're taking care of my entire financial picture, not just one little part of it.
As a physician, I know that what I do for people is really powerful and impactful, and it's important for me to know that the level of expertise that I'm working with for my financial health is there, and I have that trust for them.
It's definitely valuable because I don't have to go looking a million different places. Like, I don't have a lawyer over here, and I don't have, the insurance thing over here. Everything's under one roof.
Earned brings clarity to my financial life.
With Earned, I feel really well taken care of.
I feel my financial health is secure.
I feel supported.
Earned is security.
I would highly recommend any doctor to look at Earned.
I love what I do, and it's really important for me that my patients have the utmost trust that I'm taking the best care of them. I have that same amount of trust with my financial advisors at Earned.
Hi, everyone. Welcome. Thank you so much for joining today. Welcome to Earned's 2026 Market Outlook, the Discipline Dividend, a doctor-centered perspective on market risk and long-term wealth, brought to you by Earned and Physician on Fire. I'm Amber, Marketing Manager here at Earned, and I will be your moderator for this webinar. Earned is a longtime partner of Physician on Fire and the first fully comprehensive tax and wealth firm built specifically for doctors, their families, and their practices. We bring tax planning, investing, retirement strategies, practice level advice, and now insurance and legal coordination all under one roof so your whole financial life works together. Before we get started, I have a few housekeeping items for you. The question icon at the bottom of your screen can be used for putting questions in the chat anytime. We will answer those at the very end of our webinar during our questions section. If you want to just say hi, say welcome to everyone, use the chat icon in the very right corner. And then we will have a Market Outlook handout available for download, and that could be seen under the apps icon down below. Without further ado, I'd love to introduce to you our speakers for today. We are excited to have Jorge and Bill with us today. Jorge, as many of you know, leads the Physician on Fire community and has been a long trusted voice for physicians pursuing financial independence and long-term clarity. And if you've joined us before, Bill Martin might be a familiar face. As Earned's Chief Wealth Officer and CFA charter holder, Bill leads how Earned helps doctors and build preserve wealth across every stage of their careers. His work focuses on disciplined, evidence-based decision-making, bringing together investing, tax planning, risk management, and long-term strategy to support better financial outcomes for physicians and navigating complex markets and limited time. In today's session, Bill will guide us through Earned's 2026 Market Outlook, connecting the accelerating role of AI and involving market risk to practical, real-world decisions that support long-term financial well-being across demanding medical careers. So with that, I'll turn it over to Jorge to say a few words before we bring on Bill. Come on out, Jorge. One second, Jorge, you're muted. We want to get you.
Okay, sorry
There
about
you
that.
go. All right.
I've done it for 2026. It won't be the last.
Yeah.
But welcome everyone. Jorge Sanchez here from Physician of Fire. Hey, Amber. So excited to be on this webinar. This webinar is a special one because at the beginning of the year, we're all past the holidays, looking optimistically towards the future. A lot of noise out there. We got Maduro's arrest, the grab for oil in Venezuela, which is going to have ripples in Latin America, the unrest in Iran, a lot of stuff happening in the US, the battles between the AI companies. So really interested in seeing what Bill can give us some kind of navigation so we could, or GPS for this foggy future. So without further ado, Bill, let's jump into the 2026 market outlook.
Thank you, Jorge, and thank you, Amber, for the introduction. Looking forward to walking through what we think is a packed but helpful and insightful agenda. The 4 topics that we'll focus on is really just taking a look first at the financial reality that doctors face. We'll then turn to the key 2026 outlook themes, and then translate that third into what this means for you as a doctor. Lastly, we'd like to spend just a few minutes of exploring in a little more detail how Earned is helping other doctors like you navigate a very complex environment that we're faced with as we head into 2026. So doctors, as we know, really do have a different reality than most other high-income earning professions. As we know, there's this extended training period that means there is a later start to where earnings can really kick in at a level that's there. And once they do, the second thing is there is a higher tax burden. Of the federal tax brackets, the average tax bracket is the second highest among doctors on average. There's many of you that are in the most highest tax bracket that's there. So that is just an additional drag that's on your wealth and wealth accumulation. Because of the later start, there's this compressed earnings period that you have to really kind of play catch up to many of your peers, all while there's this real reality of burnout risk and seeking, is there a way to be financially independent sooner than later? So as we devise and put together strategies on behalf of physicians, this is the philosophies and understanding that we keep in mind as we turn now our attention to the outlook. What are some things that shaped the markets last year as we now head into the 2026? A few things we saw: policy swings and interest rate cuts. We also have seen elevated valuations. I was looking at the data there. For example, U.S. large cap in 2026 experienced about a 17.4% return. International was up even more than that. 31% for developed international, and emerging markets were up 33% in 2025. All of that took place with a lot of geopolitical uncertainty that was in the backdrop, including things like the tariffs that were taking place, the government shutdown. So if you went back and looked throughout 2026 or 2025, there was a lot that took place. And one of those things is artificial intelligence. The acceleration of that definitely took a foothold in 2025, and is going to be one of the key themes as we look to 2026. So as I just referenced, the first one is looking at the AI playbook and asking this question: are we in a bubble, or is it truly a breakthrough at this point? The second key theme for 2026 is navigating valuations. Where are there opportunities, and are there alternatives that exist that make sense? And then lastly, there's lots of noise. Just like we heard in 25, we anticipate plenty of macroeconomic noise to permeate the marketplace. What are the factors that influence you as a doctor in the market ahead, given that noise? So the first of the three themes is this AI playbook. And before answering specifically the question around, is this an AI bubble? I think it'd be helpful to just look, what are some familiar patterns that typically take place when bubbles form? Well, there's these four key themes, or four key kind of distinct phases, I should say, of a bubble environment. The first is displacement, meaning there is some transformative type of technology or innovation that takes place. Second, that innovation launches a massive boom in spending, acceleration. At some point, though, if it becomes a bubble, euphoria persists, and that euphoria can't extend forever, that then results in a bust. This is true of lots of different innovations that have taken place throughout history. And if we look to over the last 100+ years, things like the invention of the radio, the railroad, fiber optics, and the kind of precursor to the internet, all of those kind of encountered many of these different phases that are outlined here. So is there truly a bubble in AI? Let's take a closer look. I think that there's evidence that you can make on both sides. There's signs of what I'd say still discipline and opportunity, and there's signs that would point toward excess. So on that more opportunistic side, there's massive AI capital expenditures that are being funded largely by cash flows from businesses across small to very large. The estimated spend is over $1 trillion in 26. So there's been large amounts of dollars flowing into this, spending by companies to take advantage of the AI capabilities. And largely that's being funded, as it says here, by cash flow rather than debt financing. Secondly, demand still is outstripping supply. And in the euphoria phase, it's really unlikely to see that kind of supply and demand situation. Often it becomes upside down. But that doesn't seem to be the case yet. But the third point, looking at excess, there are some isolated speculative things that take place. One I wanted to highlight, so Thinking Machines, an AI-based enterprise, went out to the market with seed capital. So again, early stage, trying to form, raised $2 billion and had a market valuation of over 10 billion. And just a month later, that same enterprise went back for a second round of financing and received a valuation of $50 billion. There was no product and no earnings. So to me, that's an example of a type where this in isolation speculative behavior does appear to begin kind of surfacing. Another important, I think, aspect is what kind of exposure do most investors already have? And what's interesting as you look at this, even though you may not be thoughtfully going or trying to pursue a specific AI startup, it's likely that your portfolio, if you own stocks, have a meaningful exposure to AI already. So you can see in this chart here to the right, the S&P 500 broad-based US index, about 38% of companies are either directly or indirectly tied to AI. That's true across small caps as measured by the Russell 3000, and also in the MSCI All Country World Index. And international stocks have a fairly significant portion too. Now, just by comparison, this is a larger exposure than the tech kind of overweighting in 2000. So in contrast, going into March of 2000, tech represented 34% of the S&P 500. And it's larger than the financials pre-great financial crisis that was there, which was about 20% of the overall market at that point. So the key is, if you own US equities, AI is already one of your largest exposures in your portfolio. So the question, I think that's important. It's not, should you invest in AI or not? Because as we have established, most of you, whether you knew it or not, already have significant AI investments. But the question is really, how much AI fits into your life, your goals, your timeline, and your tolerance for risk. So playing offense, where AI benefits may show up, there's the opportunity. There's been such a strong rally that's taken place in this ultra mega cap magnificent seven. But AI also has plenty of opportunities in small cap stocks and in firms that are part of those markets. Service businesses. So it's not just call it the tech and the tech startup. Many service businesses are really kind of putting their opportunities into this AI environment. And lastly, infrastructure and real world adoption is another place where we can see this take place. So let me move on to a thought that we ran across. So just don't take my word around whether you should invest or not in AI and whether or not AI bubble exists. We ran across this quote from famous investor Howard Marks. He said, since no one can definitely, since no one can say definitively whether this is a bubble, Howard Marks is advising that no one should go all in without acknowledging that they face the risk of ruin if things go badly. But by the same token, no one should stay all out and risk missing out on one of the greatest technological steps forward. A moderate position, applied with selectivity and prudence, seems like the best approach. And we at Earned completely agree. Let's turn to the second theme now, navigating valuations. And as this title of this slide suggests, valuations are full. Said maybe more succinctly, stocks could be viewed as expensive. So equities are near high percentiles from a valuation perspective. Credit spreads looking to the fixed income markets are very tight. And long-term returns likely may be lower. And this next chart here on this page gives us a different view into what this means. So what we're looking at, there's different ways to value whether the market is expensive or not. One of those ways is by looking at price to earnings. Another is price to book, price to cash flow, price to sales. And you see a clustering of kind of these dots at the upper end of each of those four bars. That is just merely saying over the last 20 years, looking at the valuation range, stocks is measured in these different indices that are represented in the legend at the bottom, are near the upper end of the valuation range. Now, what's important to say is that just because, let's say, equities or stocks are expensive, does not mean that we're in an environment where within the next, pick a time frame, 2 weeks, 3 weeks, month or more, stocks are going to plummet. That's not what this is reading. These high valuations can run for an extended period of time. But when we look over a longer time frame, they can certainly shape, let's say over the next decade, what return potential would be. And as I shared on the previous slide, I think what this means to me as looking right now as the starting point going forward, a portfolio that's, let's say, comprised of equities and other asset classes, if it's more expensive, would simply mean your return expectations should probably be moderated. It's unlikely that over the next decade that you would see, based with valuation starting here, that you'd clearly generate double-digit returns. So for example, we're saying equities, let's S&P 500 to pick as an example, may return around a 5% annualized return over the next decade, much lower than its historical standards. So when returns are potentially lower, it does matter that you pay very close attention to how your portfolios are built. A couple of things came in mind. One is be incredibly tax efficient. We've already established that as doctors, you are high income earners, pay some of the highest taxes. Your portfolio in a lower return environment should definitely be tax efficient as best as it can, because those taxes just are one more drag that could be a part of that. minimize that as much as you can. The second is thoughtful portfolio construction. It's just not merely a matter of picking an ETF and saying, I'm done. That's all I need to do from an investing perspective. I think an environment like we are in now, durable portfolios and smart portfolio construction is more important than it has been maybe for the last decade. And the third comment is think about downside protection. It's not just about the growth. Is your portfolio designed in such a way that can weather some of the downturns that may come up, whether in 2026 or the years ahead? Now, there are opportunities that we believe still exist. On the left-hand side, you'll see a few. Fixed income is starting the year with still very attractive yields. Public real estate, if rates do become cut, may benefit from a declining interest rate environment. Alternatives, including private markets, is another area where it's important to potentially look for adding to your overall portfolio. This chart that's on the right-hand side talks about historical returns during equity drawdowns. You'll see it in three different kind of columns there: the S&P 500, the MSCI EFA, so developed markets, and the last one is the emerging markets. If you look at that green bar, you can see at the height of the great financial crisis, at the S&P down nearly 50%, over 50% for EFA and emerging markets during that time frame. But other types of assets, including alternatives, what's not represented on this chart is fixed income, provide an interesting ballast to times where there's drawdown. So going back to that thoughtful portfolio design, it's not just putting all chips on the table of, let's say, one industry, one sector, or even one market. Being thoughtful and diversified is going to be important in the environment we're facing. So what's the role of alternatives? I want to be clear. When, as investment professionals, we elect to add alternatives into a portfolio, it's not all about beating the markets. They provide diversification benefits, which help smooth out this ride. Protecting on the downside is another one. And all that is done in a way what we think is a modest opportunity cost. So if you haven't included some alternatives inside your portfolio, it may be something worth considering in the environment that we are looking at in 2026. So the third theme is this noise resistance. So as Jorge said at the very beginning, even just looking at this week, there are headlines that are everywhere that could frighten investors, like, should I just go and run for hiding, given the potential turmoil, macroeconomic turmoil that's there? If we look back in 2025, the market was loud as well. So we talked about tariffs and government shutdowns and the rate cut uncertainty, and certainly Fed leadership debates that continue even on to today, where we're seeing challenges there. And so what we look at is the data beneath the noise. And there's a few key themes I think that are important. First off, the economy is still working. Consumer spending is resilient. So looking at this last holiday season, the early sign is suggesting consumer spending was up 9% greater than it was in 2024 during the same time frame, suggesting again the US consumer is in a really strong and solid position. Another, I think, important theme is we're seeing inflation moderating, albeit somewhat unevenly. This chart over here on the right-hand side shows several different measures of inflation. The one that is the highest, the dark green line, is a measure of shelter or housing cost. You can see that home prices have still been at the upper end of, call it, these different measures. And certainly housing affordability is an important topic for our country today. But the key theme is looking at the trend across all these different areas, including core kind of inflation as well. And the reading today was 2.7%. So what that means is this target rate the Fed has of around 2%, we're still above it. If we're still above it, and unemployment is beginning, or employment factor, the labor market is beginning to show some signs of slowing and weakness. Unemployment rate begins to creep up. All those are factors that allow the Fed to potentially, continue with um, easing rates as we head into the first, second, third quarter of 2026. It's important to know that headline-driven investing is a very poor strategy, meaning you have all this noise that's going on in the market. um, it's tempting at times to say, let me just take action because something appears to be taking a direction, either positively, perhaps for AI, or maybe it's the political or macroeconomic environment that has somebody concerned. But what we know, and the disciplined investor knows, is that emotional investing often leads to incredibly bad timing errors. And why this is especially important for doctors is it goes back to understanding the compressed time frame that you have to really apply these earning years that you have relative to other professionals. So mistakes are magnified. If those mistakes are based on trying to time the market or trying to time some economic headline, could be challenging. As the subheading says, I think it's important to remember, even though there's this noise across the headlines, the economy for the most part is still working. The second point on here is don't lead to over trading. One reason that's important is just merely the more you trade creates short-term capital gains. Short-term capital gains could be taxed at ordinary income rates, the highest rates, just another further drag. So it just is important to have, again, that disciplined approach, and abandoning long-term plans is one of those things we think can be another error. Stick to what is important for your goals. Financial independence, often among this group that's here, and to do so as early as possible is going to require kind of avoiding being distracted by what the headlines is saying today and taking that disciplined approach. So positioning for 2026, a few things come to mind as we've built portfolios for our clients. There's an emphasis that's on quality fixed income. It has a place. We're going in and we see the potential for some nice returns. In 2025, just by way of reference, I was looking here, 7.3% US core bonds was the return there. A nice return from a fixed income, very stable based investment. Going into 2026, we do believe there's an opportunity for fixed income to still produce a nice level of return for investors. We think select active management can be important. Now, for the core piece of the portfolio, we often lean into more passive or index based to keep cost of the portfolio low. But things like private investments and private markets have more of that active tilt that can add some additional potential return to portfolios. And understanding, having flexibility and understanding the durability of portfolios as opposed to try and pinpoint a forecast and plan accordingly. We believe building, like I said, well diversified that can withstand various market conditions is the smart way to position portfolios in 26. So what does this mean for you? And mean for you as a doctor? Let's take a look at a few things. It's really important from an investment perspective to build a portfolio that is disciplined. It's the key theme that we said at the beginning of what this whole 2026 outlook is based upon. As we know, you don't get these unlimited do-overs. Your time horizon is compressed. Your highest earning years are limited. And the biggest risk is not missing the upside, but it's making a mistake and not being able to recover from it. So what that leads to is this thought process that's down below. Discipline protects progress. Staying invested beats being clever or trying to time the market. There's lots of studies that show that, one of which I will point out in just a minute. Risk should be measured relative to your life and to your goals, not to the market and to the economic headlines. It's really smart to ignore noise. And ignoring noise is an active decision. And lastly, your money exists to serve your life. As docs, we just recommend there's so many more important things your clinical practice, your family, your long-term goals. Those are the things to focus on as you look at your financial life. So let's turn attention now to how Earned can help and how we've helped doctors like many of you on this call. We are creating a one-stop shop for doctor financial services. We think of these in two key buckets. We think of them as individual solutions for you and your family. And we think if you're a practice owner, practice solutions as well. We're continuing to expand the set of capabilities through acquiring top talent and acquiring top companies that serve doctors here. Advice is fully integrated across domains to drive better outcomes. A couple of recent acquisitions that we'd like to mention that we're beginning to assimilate into the Earned companies. One of which happens to be an insurance, disability insurance provider expertise that's driven by Dr. Stephanie Pearson of Pearson Rabbits, a physician that for some various reasons decided to start and partner with this insurance capabilities. And that's the type of subject matter experts that we are assimilating across the Earned ecosystem of companies. Now, taking a look at our wealth management philosophy, there's a few things that I think is important too. Wealth is built over decades. It's not based on short-term market predictions, things that we've talked about earlier. And to that point, if you look at the chart over on the right-hand side, it's highlighting the hypothetical growth of 10,000 if you were invested in just this S&P 500 index. If you left it uninvested, you could see that turns over a multi-extended period here of a pretty significant sum. But what is very fascinating, if you try to time and make short-term predictions and you're wrong, it can be incredibly costly. So investors that happen to be so unfortunate as missing the best 5 days over that time frame from 1988 to December 31st of 2023 would have seen their portfolios decline by 37%. But what would happen to those if they happen to miss the 50 best days? Well, those return potential that was there now all of a sudden is cut by over 90%. So reinforcing the theme, wealth is built over decades. It is a bit of a fool's errand to try to time the market because if you're wrong, it can be incredibly costly. Discipline, transitioning to two more themes, is a disciplined tax-aware portfolios would make a really kind of well-based position. That's part of our philosophy. And then being able to have wealth that can be managed regardless of, call it, the market environment. One way that we work specifically with doctors is to look at your personal balance sheet, look at your financial goals, both currently and into the future, and do what we call Monte Carlo simulation to test, are you on track to meet them or not? So that's what this is representative in this, this page here is testing. Here's what an investor is sitting at today, looking out to when they would like to anticipate retirement. And what's the likelihood if markets were to behave in a way that was higher than predicted or lower than predicted with everything in between? And running 1,000 different trials, we saw that there's an 83% success rate in this case, that this investor is okay. Actually, this is called in the confidence zone. So anything in that green, bright green range would indicate, based on where you're at today, what your plans are, stress testing the portfolio, you're on track to meet it. I have a stat that I want to highlight toward the end of this presentation, but what we've found, often when doctors come to start work with Earned, run this kind of analysis, their probability is lower than you would anticipate. But by layering in some of the thoughtful approaches that we've talked about on this call and others, we're able to see that easily get into this, what I'd say, confidence zone where you can sleep well at night and know that your goals, you're making great progress toward those goals that you have. So our approach is built on creating resilient all-weather portfolios to perform regardless of what the market condition is. And a few of the techniques that we would use, things like customized indexing with tax-efficient solutions, using things like continuous tax loss harvesting that's automated by smart technology. We deploy things like tax-aware separately managed accounts to accelerate the ability to take advantage of tax-smart investing. All of that paired in a thoughtful approach around a curated private investment list to enhance both diversification and potentially returns. So just briefly, what is custom indexing? I mentioned that. This allows you to own the securities underneath, typically bundled in a mutual fund or ETF. But the index, by owning the individual constituent parts, allows you to do a couple things. To have a more personalized portfolio built specific to kind of to your goals. And secondly, it enables greater tax efficiency. What is interesting, even in years like last year, the market was up, the S&P, let's take 17%, and emerging markets and international developed markets were up over 30%. You would think in an environment like that, there may not be a lot of opportunity to do things like tax loss harvesting. Well, in those environments, just last year, for example, if April, you may recall, things like the tariffs just hit the market, and we were in a situation where we were nearing bear market territory. Even though we ended the year in such a positive way, if you deployed annual, not just annualized, looking at the end of the year, but looking at the ability to take losses throughout the year, can create this bank of losses that be used to offset gains in other areas of your portfolio or in other areas outside of your portfolio, such as real estate, or if you have a practice, the sale of that and mitigating capital gains relative to that. Just briefly looking at, here's the thought process of a curated private investment. This provides diversification, as I've also referenced, potentially for higher returns, given access to exclusive opportunities. 3 of the categories include private equity, private real estate, and private credit that we do the deep due diligence underneath, engage managers with proven track records, and deploy them in a strategic way across portfolios. And down below, you see a few of those names in the portfolio, whether Blue Owl, Cliffwater, KKR, a few that come to mind. We then purposely integrate tax efficiency and technology across our wealth management platform and have a way in which we can interface very clearly and easily with our clients through our own client application. In addition, there's other things that we can layer in strategies, whether it's things like backdoor Roth conversions. We can develop tax transitions and tax budgets to help save as much as possible for you, given your high income and high tax burdens that are associated with many doctors. So all this, how does this come together? I am pleased to share these are some of the results that are incredibly powerful. Let me start with the first number that's the second on this list, 2.3 million. So I was referencing earlier when I was showing the financial plan, the scenario analysis, the Monte Carlo simulations, that often when docs come in to earn, start working with us, we test their ability to meet their goals. There's often plenty of opportunity. This number, $2.3 million, is the average benefit and projected retirement net worth that we're able to add by deploying what I'd say smart, the integration of tax and investing and estate planning and other things that are there. This represents nearly a 2.5 times improvement from the path or trajectory the doctors were on before working with us. One element of that, and I've talked about this in several different ways, has been the benefit that's been accrued as relates to tax savings. So you might think the return of the market was up. We said last year, S&P up 17%. What does this number represent? It represents the benefit from an after-tax perspective, in addition to kind of capturing the market returns. So the tax savings that our investors are seeing on kind of average is nearly 2% per year that is generated from tax loss harvesting for our clients. That compounds significantly over time of creating wealth and just incredibly helps decrease that tax drag that's a part of high income investing. A few disclosures that kind of wraps my comments. We'll hand this back to Jorge in just a minute. We'll flip through these, talking about things like the Monte Carlo simulations and the indices that were used. And with that, Jorge, I'm going to hand this back to you.
All right. Thank you, Martin. That's a amazing webinar. For those of you showed up late, we are in the 2026 market update from uh, Earned. A lot of detail, a lot of nuggets there, Bill. Um, we've been working with Earned for a couple years now, and they're amazing partners. The great thing is they have this POF app that we worked with back about 2 years ago. I call it GPS, or a CFO in your pocket. You could look at your finances, your subscriptions, your patterns. Plus, you could also get to see our content from Physician on Fire to educate you on these kind of things. There's a QR code there. Lastly, what I like about Earned is that they're one-stop shopping. You get your accountant, your CPA, estate planning, and other financial services working together and communicating with each other. So it really builds a really neat ecosystem for your finances. You know, as physicians, we work hard for our money. We have a very short horizon of earnings. So any little mistake gets compounded, and that's a big deal. Um, you can get a free evaluation by Bill and his partner, um, and it's Trevor we've worked with before. So check this out. So great. Also, if you have to depart and see patients, you're going to get an email with a link so you can see the webinar. It's in its entirety. Um, and I think that's it. So Amber, I think we've got some questions, right?
Yeah, thank you so much, Jorge and Bill. That was excellent information. Again, book your free consult with Earned using that QR code. I also have it available here on the stage for you. If you take a look in your bottom hand corner, you can click that link and book your free consult. Awesome. Okay, let's go to questions. We do have a few on here that we want to get started. So Bill, I'm actually going to flip slides really quick so we can see this. Ricky has a question for you. What would be the advantage of adding other fixed income like corporates or alternatives like private equity? Do you mind answering that for us?
Yeah, absolutely. I think of this as like a portfolio. I don't know if this is a great example, but what it comes to mind is, let's say you have your home and you think about the different spaces that you use. There's different purposes and intended kind of kitchen, bedroom, bathrooms, etc. And so I think of often when I'm looking at portfolios maybe managed by do-it-yourself investors or others. This isn't always the case, but it can be. It's like there's this one big room. It's one big, let's say, asset class. Maybe it's just an S&P 500 index. Well, you're missing out on, call it, the benefits and capabilities of these other rooms that you'd have in a normal house, where there's mixtures of different, they serve different purposes. In the same way, kind of building a portfolio, whether it's fixed income like corporate bonds, maybe alternative portfolios, it's important to have those because they all serve kind of different purposes than just, let's say, putting all your investments in a large cap equity fund. For example, as I was showing and referencing, fixed income provides more stability and ballast to portfolios. So during periods of drawdown where you saw, going back to the great financial crisis, if somebody was invested in the S&P 500, they would have seen their portfolios fall nearly 50% during that time frame. If some of those investments were put into, let's say, a more safe but lower returning piece, you would have kind of counterbalanced that and not seen those portfolios decline nearly as fall nearly as far. Protecting capital, protecting the downside, I think is an important piece for doctors, especially what we were talking in this compressed earning time frame. So corporate bonds and some alternatives, depending on the type of alternatives, can help provide that almost like portfolio insurance or portfolio durability was a term that I used. Now, private equity to me serves a different purpose. That is investing in companies that are private. Those private companies have not yet either gone public or trading. And what's interesting is public markets, the ability to go and invest in a stock just as a retail investor, are shrinking. The number of opportunities, because there's so much capital now that flows into the private markets. Companies can stay private forever, indefinitely, or at least much longer. The vast majority of companies are private across the US. But what makes that interesting, there's often barriers of entry. You have to have a certain income level, or there's other things that are there. So private equity, if managed by, let's say, a distinct manager that focuses in that through a curated list, like we talked about, added to the portfolio, can be additive from a returns perspective, generate higher returns, potentially even than the broad-based market. And some of that is driven because what we refer to as an illiquidity premium. Often these private investments, private versus public, means there may be some liquidity constraints there. In exchange for keeping that money invested longer, there's the expectation of higher return. So in this case, back to the example of the house with different rooms, this purpose would be, let's kind of add some additional return, but not just put everything there because, again, some of the things like illiquidity that might be a part of a private equity strategy.
Awesome. Thanks, Bill. And I really appreciate the analogy. That I think that helps simplify things. Ricky actually has another question for you, a little bit more targeted. So would I be able to meet my retirement goals just using a total stock market index fund or total international fund, and then a short-term treasury index funds, and just rebalance every year? I know it's very specific. So even if we want to give a general.
Yeah.
Yeah.
I would just, for my first comment is those that are part of this webinar, first off, you are likely very interested in financial matters. I would say being doctors, incredibly smart. And what does it mean to be a do-it-yourself investor? Could you take a strategy like this and meet your goals? The answer might be absolutely could. Now, my question, I think on the flip side is, what would you potentially be missing? So what Earned is trying to solve for is not just a smarter way to invest. And things like we've talked about, tax smart investing. I mentioned one of those of like the ability to do tax loss harvesting. Some other things that I didn't mention were what I call tax diversification of your portfolios, being really, really thoughtful, intelligent in how you build your financial plan and link it to that to build wealth in different buckets. Because when you begin to start pulling that wealth out, if you haven't diversified tax-wise into, let's say, tax-free accounts, tax-deferred accounts, taxable accounts, you're going to lessen the likelihood of your portfolio longevity. You're going to maybe not be able to have as high of income as you want. So things like not just, okay, here's the asset allocation and using some pretty easy to access ETFs and saying it's good, it might work. But I would say what we're able to do, and the reason we saw that magnitude of earnings on top of that when building financial plans, there's things like, again, integrating investing in taxes, integrating estate planning to make sure the legacy assets are done in such a way, thoughtful insurance reviews and making sure there's adequate components there. And in one way is also just the discipline of when there's these headline noises, helping investors be almost like that personal trainer, navigating those difficult self-doubt periods that Ricky may not be one of those, but I know a lot of investors, you hear these headlines, it's easy to get caught up into it, and taking that disciplined approach with a guided pro can really be helpful.
So good. No, thank you, Bill. One question I have that we've seen and we've written out actual on in POF is like one, why do I need an advisor? Which you've answered part of it, and how can I tell what's a good or a bad advisor?
Yeah, as far as you're right, I did touch on some of those elements of being an advisor, but there's some studies that have been done by independent groups, Vanguard. There's another one that's been done by InvestNet and a couple others that are out there. And what's interesting is they have attempted to answer the question, what is the value of an advisor? One of those elements is just having a smart investment and portfolio strategy relative to your goal, and to manage that tax efficiently and do things like rebalancing. It adds some value generally. Other things like layering on the ability to tax manage this, like I referenced, can add some more benefit. And also call it, say, the behavioral coaching and helping clients through these difficult market environments, stay true to their goal, and just general financial planning. All that, the studies often show more than 3% per year can be added by the benefit of having an advisor. Doing this in a coordinated approach. Now, I would say Earned goes a step further. Doctors are busy. And you often find yourselves navigating not only, let's say, your wealth advisor, but your wealth advisor separately with your tax planner, CPA, maybe insurance agent to help with different things, perhaps legal services, tax and accounting. By having that all under one roof, with your wealth advisor as being the quarterback, can ensure that rather than you as the busy professional trying to connect the dots across all those, can actually do this in a coordinated way. And that often is where some of the greatest value that we're able to deliver for the clients is the coordination there. Because if not careful, trying to do some strategy over here in your portfolio, but don't link that back to your CPA, can end up being one of those very costly mistakes that I spoke about. And Jorge, you mentioned the second part was how do you know a good advisor from one that's not? I would say one of the first things to test is whether somebody is structured, their business is structured in such a way that they are fiduciary. And it's not easy to tell because often advisors just say, I'm a wealth advisor, financial planner, um, financial advisors. There's lots of terms and there's no industry standard necessarily based on what somebody calls themselves. But if you could ask the question, are you a true fiduciary? Are you taking my best interest? Are you organized in such a way that is like that? And I think that's a step in the right direction. One example of that, registered investment advisors, that's what Earned is organized as. It's not just do we want to be that, we're required by law. So if somebody is operating as an RA or registered investment advisor, that would be an indicator that they're operating on a fiduciary basis. Again, required to act in your best interest. As opposed to, let's say, a broker who's selling you product, like picking up the phone and saying, I got a great stock idea, or here's a new real estate investment. They're going to get paid to you based on a transaction. And the only regulatory hurdle they have to meet is that investment suitable? So it's a much lower bar. And again, there could be lots of conflicts of interest that are associated with that. So that'd be the first question. I think another one is the breadth of services. So there are some advisors that are delivering what I'd say more just investment management. They'll build your portfolio. I would say that's becoming more of a commodity. There's a lot of do-it-yourselfers that can do it, as was referenced in this context. But doing that in coordination with tax planning, insurance planning, estate, kind of thoughtful estate design. In our case, aligning that with career goals, objectives, career advisory, tax, insurance, others. That's where I think it's helpful to know what are the capabilities and how can I tap into those capabilities as much as possible. So start with, are you a fiduciary or not? I think, and then look to what are the capabilities. Last thing is credentials. So I have a CFA, a Chartered Financial Analyst. It's more of that investment-oriented kind of credential that's there. From our advisor perspective, we are looking at most advisors to have what we refer to as the CFP designation. It's really something that goes across whether it's investing, tax, estate, insurance, some other aspects, financial planning being a key one of those. That is a professional designation that would indicate here's somebody that's passed a series of tests that is a standard that's kind of an industry-wide that would be a higher mark than just somebody that has, let's say, no credential that's there. So I throw those out as some criteria, and Amber, I know you'd referenced, and Jorge as well, as far as we'd love to be able to have a conversation with you if you're exploring what does that advisory relationship look like. If you work with another advisor, you can always do this second opinion and say, is there something potentially I could be doing more? And often we can find that, even if somebody is working with, let's say, another financial professional. In the case of a do-it-yourself, this might be an interesting opportunity. The complexity of your financial life now warrants having some professional advice that's associated. We'd love to have a free complimentary consult to talk through that with you, and you can explore that. Does working with an advisor like Earned make sense for you?
Got it. You actually, to one of these slides, I know I'm supposed to avoid emotional timing errors, but how do I actually tell the difference between being rationally cautious and being emotionally reactive?
Yeah, that is tough. I'm going to start by telling you a story, Jorge, and I'll come back to answering that question. And I had a friend of mine a number of years ago that was really excited going to do kind of a once in a lifetime fishing adventure in Alaska during the salmon run. And so hired a guide, and the guide said, because these salmon are running, there's also other predators that are in the marketplace that are trying to capture these, including big grizzly bears. And if you see one, or if one wanders your way while you're fishing, your reaction is going to be to run. And he said that is the absolute worst thing to do, because if you try to outrun a bear, that bear is much faster than you. You will not succeed. So you just raise your hand, stand firm, slowly back up is the best path. Now, what happened? This particular friend of mine did encounter a bear. Fortunately, he took the guide's advice and is still alive and well today. So as you think about that, I just use that as like a cautionary tale. It's so true with investors, and you put this magnification of compressed earnings for doctors. It is so easy just to say, I got to make this up. And so this emotionally driven decision of if I can, and it's often either one of two extremes. I'm missing out on something great. I need to be chasing after, could be anywhere from like AI, as I talked about, cryptocurrency, an individual stock, something, a private real estate investment that I'm going to just put all in. It's the thing that's going to help me catch up. That is often where we see mistakes that are made. Again, emotionally driven, not from a kind of the other area, other extreme too, has often been, well, I don't know how to navigate this. I'm just going to sit on the, excuse me here. I'm just going to sit on the sidelines and go all cash. Well, the problem is it's a huge opportunity cost. You would have missed, a 17% return in the market this last year. So going to those extremes is the first one that I would just say. The other is what that doesn't mean, though, to kind of rational versus irrational. The irrational side is there's some event that's taking place, and I'm just going to react and try to get this right, because the data would suggest just investors overall are very bad at trying to time and make those decisions well. What it doesn't mean, though, is what's the rational aspect? There's elements that are taking place in the marketplace, like we talked about, like I was talking about. Equities are valued higher than they have been. So what does that mean? Well, we need to take a step back. Let's factor that into your financial plan. Let's stress test now with a lower return environment. And as this community wants to do, financial independence, retire early. Let's test that against that goal of perhaps retiring early with a low return environment. What does that now mean for your savings rate? Is there a little more risk you need to lean into, or vice versa? That's the type of what I'd say rational investing in wealth management relative to your goals, your circumstances, in this broader macroeconomic environment. So hopefully it gives you two contrasts. Don't see something either chase toward or run away. Step back, really see how this impacts your overall financial picture, and make smart decisions.
Yeah, and to follow up with that, you say that the biggest risk is permanent mistakes, not missing the upside. But let's say I'm behind, if this applies to a certain cohort, if I'm behind in retirement savings because I started late, like how do I know whether I need to take more risk to catch up, or playing it safe is actually the permanent mistake? For me, the answer is that's why you need a financial advisor, because they can play those Monte Carlo simulations and tell you safely what choices you have. What do you think?
No, I completely concur. In fact, that's what I was going to say. It's one of the best uses of financial planning into this. It's taking a look at a lot of different scenarios. Since we can't predict for certainty with certainty what the market, what the future is going to look like exactly, we can test multiple different things and see if you're still on track. And I think that's a great way to start and to kind of engage an advisor in those activities. And then the follow-up is, okay, based on what that shows. And there's not always like a right or wrong decision. Sometimes we see clients that are perhaps undersaved. They're behind where they want to go, and the math just simply doesn't work. So what you can do is you can potentially save more. It could cost a little bit from a lifestyle now to fund future. You could also be more aggressive, and that being more aggressive might work out and might not. And there's some trade-offs that we can show kind of along the way. The last thing I would just say from a financial planning lens is these are not plans that are built, put up on a shelf, never looked at again and dusted off. Financial planning is dynamic. Life changes, markets change. It's really important to kind of continually revisit and look at this. Am I still on track? Am I making the progress that I need? What circumstances have changed and reflected accordingly?
Got it. Got it. So, do we have any more questions, Amber, before we wrap it up?
We do not have any more questions, and I think this is a perfect time to wrap it up, get people back to their meetings and all their clinicals that they have. I just want to say thank you, Bill. That was a wonderful overview of what our market is going to look like this year. It's also a great analysis of kind of where we came from and where we're going with our financials for our physicians that we have as an audience today. Is there anything you want to add, Jorge, before we take off?
No, a couple of things as we wrap up. I think the big takeaways are first, ignore four things. First, ignore the noise, whether it's Iran, Venezuela, or the next crisis that dominates the headlines. Just stay disciplined and invest because instead of being clever, you don't get unlimited do-overs in your compressed earning years because that's a challenge of being a physician. Second, if you already own AI through your index funds, the question isn't, should I invest in AI? It's how much AI risk fits my life, my timeline, and stress tolerance. Third, in a high valuation environment with lower expected returns, details matter more than ever. Tax efficiency, thoughtful portfolio construction, and downside protection through your years aren't optional anymore. They're essential for a physician investor who can't afford big mistakes. And finally, I mean, as 2026 starts, remember why you're building wealth in the first place. Your money exists to serve your life, not consume it. Focus on your patients, your family, and what actually matters. And that's why we're here at Physician on Fire, work with Earn to help you protect.
Awesome. Thank you so much. I really appreciate it, Bill and Jorge. And thank you to everyone who showed up. Like Jorge said, we'll be sending a recap of this webinar and link, and we'll see you next time. Thank you so much for joining us.
Thanks
Thank
so
you.
much.
Have a great night. Bye-bye.